All right, I think we'll go ahead and get started. Good afternoon, everyone. Thank you for joining this virtual roundtable. It's another installment in a series of webinars and events that McGuireWoods is organizing for private equity investors and independent sponsors, capital providers pursuing energy investments. I'm Tom DeSplinter. I'm with the private equity group here in the Chicago office of McGuireWoods. And we're joined by a great panel today. I'll give a quick introduction for each of the panelists, and then we'll get into the questions and topics. For the participants on the website or on the WebEx, you'll notice a question and answer function on the bottom of your bottom right hand side of the WebEx. Lines should be muted until the end here, but if you have any comments or questions, please feel free to post them in the Q&A portion there, and we'll track them and then get to them at the end. Leave a little time at the end to address the questions. All right, so introducing our panel. First, our guest panelists, we have Evan Williams, who is the president of Cambrian Energy Development. Cambrian is the leading developer of biomethane projects in the United States, having developed 50 projects since 1980, including landfill gas and digester gas conversions to electric power, cogeneration, pipeline quality gas, and direct use applications. Evan has served on the board of directors of the Coalition for Renewable Natural Gas since its founding, and he participates in a number of advisory boards in the industry. Thanks for joining us, Evan. Next is Ryan Erickson, who's a managing director at Trillium, where he oversees operations, business development, and growth strategy amongst its various fueling options. Trillium is focused on applying solutions to industry leaders with ESG priorities by reducing or eliminating harmful emissions and climate change. They build large-scale, high-performance, low-emission projects for trucking fleets, transit agencies, and municipalities. They've developed new assets, including renewable energy and alternative fuels infrastructure, and they're one of the most respected providers of transportation services. So thanks to our guest panelists, Evan and Ryan, for joining. We also have a few of our respected and foremost experts in the field from McGuireWoods. Brian Kelly, who's the chair of our firm's energy industry team. Brian advises energy industry and financial clients on a wide range of transactions, including M&A, energy project and infrastructure development, project finance, and structured commodity and hedging transactions. He's worked on solar, wind, biomass, natural gas, geothermal, and battery projects, as well as non-energy infrastructure commodity financings in the U.S. and internationally. Doug Lamb is co-leader of McGuireWoods' ongoing infrastructure and public-private partnership initiative. He was formerly the head of each of the firm's biomass and renewable energy teams. He advises developers, sponsors, buyers, sellers, borrowers, lenders, debt and equity investors, and other commercial participants and finance renewable energy, resource recovery, energy efficiency, economic development, and transportation and infrastructure projects throughout the U.S. And then Allison Wood is a partner here at McGuireWoods. She is the nationally recognized leader of the environmental law group here and focuses on climate change, where she's guided clients through complex, politically charged, precedent-setting cases before the U.S. Supreme Court and courts of appeal. She leads our environmental, social, and governance (ESG) policy, which we're talking about. And again, I'm Tom DeSplinter, your moderator, focused on private equity investments in M&A and other general corporate transactions. I spent several years in the energy industry at BP and the Blackstone portfolio company, focused on regulated transmission. With that, kind of get into the first topic. I'll direct it to our guest panelists first. Evan, maybe I'll start with you. And given maybe ask you to give an overview of the current landscape of the renewable natural gas industry and responsibly sourced natural gas. Maybe touch on that also. Maybe just set the table for us and give us a little background on what we're talking about when we use those terms.
Thank you, Tom. It's a great pleasure to be here today and share this with you today. I'd like to start with a little vocabulary because these terms are often used but not often understood. So let's talk about what is responsibly sourced gas. Responsibly sourced gas is natural gas that has been produced and delivered pursuant to a process that has undergone third-party review and certification as to its compliance with best environmental practices, with a focus on air quality and emissions, primarily methane leaks, impact on land, impact on water quality, and community involvement. Responsibly sourced gas is a fossil fuel and is not renewable energy. It is referenced and emphasized primarily by those in the natural gas industry, including natural gas pipelines and natural gas distribution companies. Now, what is renewable natural gas? Renewable natural gas, which is also known as biomethane or high BTU gas, is a product gas that meets the injection standards of natural gas pipelines and that is derived from processing raw biogas, landfill gas, or synthesis gas collected after the anaerobic digestion or thermal conversion of organic waste materials. Now, the organic waste resources from which it is commonly derived include landfill gas from sanitary landfills, biogas collected from anaerobic digesters that process animal waste, which includes dairies, swine farms, and poultry farms, biogas collected from wastewater treatment plant anaerobic digesters, biogas collected from anaerobic digestion of food waste and other organic waste materials, including agricultural crop waste and forest slash, and synthesis gas derived from the thermal conversion of all types of organic waste. Now, why is RNG both different from and yet a complementary fuel to the other renewable energy technologies such as wind and solar? Well, wind and solar projects serve one primary purpose, the production of renewable electric power. However, that power is produced intermittently when the wind blows or the sun shines. RNG is a renewable fuel that serves two important purposes: the disposal of organic waste, which is an important municipal and societal function, and the production of renewable energy. RNG is a base fuel. It is continuously produced, but can be transported through existing natural gas pipelines or by virtual pipelines, which are mobile tube trailers, and stored and dispatched on demand. It can be used as a fuel in existing prime movers to produce electric power to balance the grid when intermittent wind and power are not being produced. RNG is flexible in its end uses. It can be used to produce thermal energy, heating homes and buildings, to produce electric power, both in existing natural gas engine generators, as well as an energy source for the production of hydrogen for use in fuel cells, to produce RCNG, also known as renewable CNG, for use in CNG vehicles, and to produce hydrogen for use in mobile fuel cell electric vehicles, as well as in stationary fuel cell electric generators. So what has been the RNG industry growth over the last 10 years, and what might it look like going forward? Well, for 30 years, prior to the founding in 2011 of the Coalition for Renewable Natural Gas, which is the leading RNG industry trade association, there were fewer than 30 operating RNG projects in the United States. In 2021, 10 years after the founding of the RNG Coalition, there are now 200 operating RNG projects with 80 more RNG projects in permitting and development. So how large is the playing field? Well, there are more than 43,000 potential sites with organic waste that have been identified as potential locations for RNG projects. It is a target-rich environment. I'd like to say that I've been involved in this industry for 40 years, and yet I am extremely excited today because with the changes that have happened from a regulatory, legislative, and technical basis, it's like the Wild West days when we first began, with new ways of disposing of organic waste and with new potential revenue streams, which include ultimately hydrogen, the utilization of CO2, and what particularly excites me, carbon-based commercial products that may have higher value ultimately than even RNG will help stabilize the revenue streams for financing purposes. I'm really looking forward to developing for the next 40 years, after which time I must say that I plan to kind of cut back my time commitment to 7 days a week. So let me step down from my pulpit, and Tom, I'll yield the floor back to you.
Well, thanks, Evan. That was very helpful, and definitely set the table and gave us some terms to work off of there. But I think the key we'll touch on responsibly sourced gas, but the key I took away from that is that that's still fossil fuel, whereas RNG is bio and others forms that we're really going to be talking about more today. So maybe I'll pivot over to Ryan. And Ryan, can you give us a sense of what Trillium is looking at in the market, what your view is, and your view of the current landscape?
Sure, and thanks for having me today. I gotta agree with Evan completely on the Wild West. That's definitely what the renewable natural gas space looks like today. And to Evan's point, it's actually been around for quite a while. There's been landfills that have been producing renewable natural gas for years and years and years, normally for electricity production. And then the advent of solar and wind sort of, showed, I think it kind of pushed the landfills out of the electric production space a little bit. There became the focus of taking that renewable natural gas and really trying to clean it up to the levels of regular fossil natural gas, the pipeline gas that we have, going to basically every home and business in America. And so I think we started to see maybe 10 years ago, that gas starting to go into transportation more, probably, waste management and companies like that being some of the first and the biggest to do so, since they were already at the landfill. Why not, fill up their trucks with it? But we've seen a lot of, a lot more technologies going to the space, a lot more technologies improving, and cleaning up gases, various different types of gases. And now you've got landfill and dairy and swine and all these other waste streams, wastewater plants. And depending on where you're from or where the gas is going, state of California actually tries to figure out how much carbon was removed in the creation and use of that renewable stream now going to transportation or other areas of the natural gas market, and assigning a value even based on it, right? They have their low carbon fuel standard credit program that I think you'll be talking about a little bit later. And certainly then, EPA and the federal government has their RFS program with the RINs, somewhat similar to the LCFS program, but not focusing more on just the fact of it being renewable or not, and less so on kind of how much carbon might have been removed from the atmosphere because of its conversion to a usable fuel. And so Trillium really started its career, started its life out developing natural gas fueling stations to fuel engines that would lower criteria pollutants. Wasn't really at the time thinking much about renewable natural gas and greenhouse gases. Trillium is owned by the Loves family, who is known for the Loves truck stop travel stops. And so they've been fueling goods movement for 60 some years now at this point. And so just starting to focus on how to provide fleet customers what they're looking for as they're trying to clean up their operations and have an ESG focus, sustainable focus on their business operations. And so we're trying to at least bring what we can to the table. We're not going to be able to help them with certain things, governance and some other aspects of ESG, but we think we can help them out when it comes to their transportation needs. And even as that kind of moves outside of transportation, once you've developed all of the assets that Evan and his company have developed, to produce renewable natural gas, it doesn't have to go to a vehicle. It can go to, a boiler facility at some manufacturing spot or whatever. And it's still, reducing the use of fossil fuels, which would otherwise, and then therefore reducing the carbon that's going into the atmosphere, really to serve no purpose, like would otherwise happen at a dairy farm or at a landfill. So we're just trying to really be in that vertically integrated stream of production all the way to use, and think that there's a good business model there for a lot of other companies to be looking to do the same.
That's great, Ryan. Thank you. And you mentioned a couple, really interesting points there that I want to hit on. But you mentioned California and the low carbon fuel standard. I just wanted to maybe pivot over to Brian Kelly and Doug Lamb, our regulatory attorneys here, maybe who can weigh in on what they're seeing is what's driving some of the investment. And you touched on some of the things like the RIN credits and some of the regulatory changes. But Brian, maybe I'll kick it to you first, or and we'll go to Doug.
I'd rather start with actually Doug. Why don't you chime in and I'll follow your lead? Okay, great. Thanks, Brian. Certainly on the, the drivers, the LCFS and the RIN are big drivers in the market right now. And I would even go back to some of the discussion Evan and Ryan were having just about the history of it. There always have been drivers on the federal policy and state policy sides for a lot of these types of assets. It goes back to tax credits that were in place for landfill gas to electricity early on, and even alternative fuel credits that have been in place over time. And as the market has developed and more of those policies and initiatives, which the Coalition for Renewable Natural Gas has really works hard to help shape, have evolved as well. And certainly when you look at the LCFS in California and the way it's structured to really reduce carbon footprint and transportation fuels, and creating a baseline and a sort of debit system, a credit deficit sort of approach, has really helped push those regulated parties to import and use gas and clearly bring it in from all around the country. That's been one of the big drivers now, is the fact that you can do a project in Brian's backyard in Baltimore and sell it into the pipeline system and have an offtake in California, and it will qualify based on the CI scores and all of that. And there's a really quite a ecosystem out there about measuring carbon intensity. And to Ryan's point, the number of companies out there that are involved in this and the expertise is quite dramatic. So that's just on the state side, the LCFS in California. I think perhaps there's one other state, somebody can correct me if I'm wrong, Oregon, I believe, has one, but and some others are in the offing, but I don't think have been finalized. But that's a couple months old, so something could have happened over the summer that I'm unaware of on the state side. And then of course the RINs is part of the renewable fuel standard at the federal level. First came into place in the aughts, got tinkered around with, and became RFS2. And there are several classifications of RIN credits there. There obviously everybody knows about ethanol and the fact that that really is one of the greatest compliance fuels for the RFS. But in that are the cellulosic category, the D3s, which when Ryan and Evan were tinkering off the different sources, landfill gas, animal waste, all of those tend to qualify for that D3 RIN, so long as it's not adulterated by other injectants in their feedstock. And so that at the federal level and in the state level really have been driving things. Allison will get into the ESG side. I think it has to be said here, that's been a big driver as of late in terms of companies and investors approaching the marketplace. We've certainly seen it, and it's almost a weekly occurrence right now, to be candid. And so down the road, the eRIN market we expect to develop as well. That will be the fact that dispensing fuel into electricity for powering vehicles will develop as a pathway, and the pathways under LCFS and the RFS are the mechanisms by which you create the eligible fuel for use. And that maybe Brian, you want to talk a little bit about the rec side and
just to piggyback on what you're saying there. There's really, to me, in my mind, there's three main reasons why you're seeing such a tremendous increase in the activity in the space. And it starts off with a general market reliance on the credits that are available. In early days, the regulations were a bit less clear. There are some bad actors, and certainly in the RIN space, some bad actors. Those days have gone by. There's a much stronger regulatory regime, and there's a greater market acceptance that the credits that really help monetize these or support the modeling for these projects are going to be around for the long term. Secondly, you have an overall, and I think Ryan really touched upon this well, you have a tremendous amount of experience and depth coming into this space that hasn't been there previously, whether it be from a marketing perspective, a development and technology perspective, or a straight up developer perspective is going out there and putting projects together. That's really driving a tremendous amount of growth and putting together those projects that Evan touched upon in terms of the number of projects that are out there. And then third, just many people on this call, people are chasing returns where you would normally in 10 years ago, 5-10 years ago, you'd be driving, getting strong returns off of utility scale, utility and solar and wind plants. You're not seeing that as much, but you can get strong returns off of these types of projects. And at the same time, benefits of the solar and wind market has given people the understanding of what we mean when we say a contractual pathway for eRINs or for RINs perspective, from a marketing perspective, or recognizing the ability to generate commodity in one part of the country, just as Doug mentioned, and have the general offtake being in another part of the country to drive the modeling. People are understanding that it's more mature and people have more comfort associated with that. Now, as Doug was highlighting, there is also the rec space, of course, that was tied to electrification. That, as Ryan was noting before, that's how we all started in the LFG space. That's where it was going in terms of electrification. But the overall value of the RECs compared to what you see from the RIN space in particular and the LCFS credits really pale in comparison. You don't see nearly as many, and I welcome anybody to challenge if I on the panel disagree. You see mostly all new development going towards transportation for the simple fact that it's where the market's heading to, and it's stronger returns, and less so on the rec side. The fourth one, if I can add to my own list, and I'm going to pass this then off to my colleague Allison, and maybe Tom, you can expand on the concept a bit more, is the overall ESG driver on all these investments and what you're seeing and what's bringing, not only when you put together the amount of experience that's coming in this space, the regulatory regime that's helping push these projects, but then also the general climate, pardon the pun, regarding ESG in particular. You're seeing a tremendous increase in activity here.
Brian, yeah, I think maybe Allison will kick it over to you. I mean, Brian mentioned a few things there, and we've talked about ESG, quite a few times here. But we'd definitely like to hear your thoughts as one of the leaders in that industry.
No, I mean, you can't trip over yourself, right now and not hear about ESG. And I've been in the climate space and doing climate law for over 20 years, but you've never seen growth in the same manner that you're seeing right now with ESG. And of course, what we're talking about here is the E piece, environment, but really all of that is driven by climate change and companies wanting to come up with some type of a response to climate change. And I think, you saw that when Ryan was speaking, right? He talked about a company wanting to figure out for ESG reasons, how could it lower its carbon footprint? And, multiply that, 1 billion times, and 1 billion companies all wanting to do the same thing and to figure out what can they do in this space to say that they're sensitive to climate, that they're doing their best to lower their carbon footprint. Not only, the pressure on companies on the ESG front is tremendous from their shareholders, from their boards of directors. They need to do things from, and in terms of people being willing to invest in them. There are a lot of, large retirement funds, public retirement funds that won't invest in companies that, aren't committed to this. You were talking, Brian, about, like every day, you see something, or every week, I think you said on, kind of on the ESG front, it's more like every day. You see another company coming out with their commitment to when they're going to be at net zero, meaning, no carbon footprint. And honestly, in terms of how do we get all these companies to net zero, you're going to have some kind of program like what we're talking about here, some type of credits, be it RINs, be it, the LCFS program, be it RECs. Depends on the transport, whether you're talking about the transportation sector or you're talking about, the electric generating sector. You're going to need these types of credits. And as more and more companies need them, and they need them to be able to say they're reaching their net zero goals, the demand for these is only going to skyrocket. which means the supply is going to have to match it. And, that goes to what Evan was talking about in the beginning about what he's seen, with landfills. I think it was 30 that you said, 10 years ago when your association started. And I was surprised actually that it's only a little over 200 right now. I'm not surprised by the 43,000, potential sites. And I think that, those are 43,000 potential sites with a lot of potential because the demand to be able to say that you're doing something in this space and yet continue in your business is huge. So let's take Amazon, for example. Amazon said that, they have a commitment to being, I think carbon neutral by 2030, which is a very aggressive target. That doesn't mean they're not going to still be delivering all your boxes and your packages, but it does mean that they're going to need, to power their vehicles with the types of fuels we're talking about. And it means they're going to need to have the credits that we're talking about available to them. So yes, ESG is driving a lot of demand, and it's only going to increase, I think, as we move forward.
I can tell.
If I could add one thing onto that, I'm sorry, and it was an interesting point that Allison brought up in terms of the development of wind and solar assets as it relates to people trying to meet their carbon neutral standards. You can only build so much wind and solar from an operational perspective. You're going to need to have a fuel that you can be able to turn on and off at will compared to a generation source that's by definition intermittent. RNG helps really bridge that gap in many ways, and it helps take advantage of infrastructure we already have in place, and it'll be able to operate and be deployed in a way that allows baseload generation to act in a baseload manner, which is something that people often overlook, but is, if anybody's familiar with California and the duck curve, recognizes that there's real true issues associated with just relying upon any kind of intermittent generation to maintain an overall carbon neutral position.
That's an excellent point, Brian, and one that I intended to make. So I'm really glad you said that.
I'm sorry I stole your thunder.
No. And I think it's important to remember that all of the wind and solar that's being added, and there's a tremendous market there right now too, is going to have to be backed up by something that can be ramped up very quickly, when the sun doesn't shine and the wind doesn't blow, or there's just not enough, and load is high. Say it's very, very cold, or it's very, very hot. And those are natural gas peaking plants. And as electric generating companies say they're trying to, lower their carbon footprint, what are they going to burn when it comes between a fossil, just a straight fossil fuel, or if they can burn RNG? The RNG is better because they can say that it's renewable. And so again, increasing demand for these products. And the other important point is, taking a step back just for a second and thinking about climate change. We're talking about harnessing power from things that are going to be going into the air anyway. So you have these 43,000 landfills across the country that are emitting methane. Methane is a very, very potent greenhouse gas. It's a ton of methane is equal to about 30 tons of carbon dioxide. That's going to happen regardless, because we're going to have trash. So if we can, figure out ways to capture that methane, reuse it, that is good for the environment because it is pulling out of the air and repackaging that source of energy in a much better way rather than just letting it go up into the air and continue to, increase the greenhouse gas load in the atmosphere.
And Allison, I want to pick up on that point just real quickly from a resource conservation perspective, because you brought up that constraint. We'd been talking about incentives earlier. There are so many policies going in place around the country on local level, state level, that do things like ban land application of animal waste or divert waste streams organic waste streams out of landfills. And notwithstanding all of that, something has to be done with it. Then you have further development of things dealing with digestate from the facilities, and what are the byproducts and what can be done there, and how do you factor that into a pathway score? And so you have the market. There is a carrot and stick element that is really driving a lot of this. And I wanted to bring that up because depending on where the project is and what the rules are, you might have a different regulatory overlay.
Yeah, Doug, I just wanted to add one thing to Allison's comment, because I live in California and did a lot of our projects there. By law now, by 2045, there will be no fossil fuels used to produce electric power. So since natural gas is a fossil fuel, if you connect the dots today, Southern California Gas, which is the largest natural gas distribution utility in the country, 45% of its load is going to produce electric power. So if you connect those dots, it'll be half the size of the company it is in 2045, unless it can get a renewable fuel in. So I think that starts to underscore the demand that's going to get created for this type of fuel.
Evan and Ryan, I think, from a commercial perspective, as you guys are looking, as investors, do you feel that investors are, more favorable to one type of RNG over another, whether it be landfill gas or anaerobic digesters?
Well, I think I can give you the definitive legal answer to that question, which is it all depends. And, I say that because there's a lot of different factors. Landfill gas is probably the largest source today for producing renewable natural gas. They're very large. But the carbon intensity score of landfill gas is not what it is in these other technologies, for instance, in dairy digesters or the other animal waste. However, those projects tend to be a lot smaller. So for those who may be dabbling in the financing of these type of projects and may be attending this webinar, there may be a concern of, well, can I deploy enough capital to get it? And there are certain fixed capital expenditures or development expenditures you have, irrespective of the size of the project. So there are some things driving this. If you can get $80 or $90 per million BTU for the sale of gas, which is achievable if you get to the LCFS credits and certain of these very low carbon intensity fuels, even somebody with legal training like myself can make money at those rates. However, that all depends upon what the size of the project is. You may make a lot of money on a very little quantity of gas. And so there are a lot of factors that determine what might be the most desirable way. Personally, I feel the future is going to be with alternate means for developing renewable natural gas, which may include the thermal conversion technologies, which haven't really taken off. But, you only get a third of the raw material that converts to renewable natural gas in a landfill or in an anaerobic digester, whereas thermal conversion will get 80 to 90% conversion in a very short period of time. So there's a lot of things that are going to dictate the investment appetite for these kind of projects going forward. Ryan, do you have a different view of that?
No, I don't. I think that you said it very well. I would maybe say it, one different way, which is to me, it's probably mostly viewed as a risk reward balance as to, how you're looking to invest. There is more money to be made in today's market on those low CI projects, but they might have more seasonality to them. They might have more risks due to storms and other things like that. The landfills are kind of steady producers of gas, and you can normally find somebody that can, purchase that gas from you, maybe even at a fixed price. And so it's just it's a much safer investment normally than the kind of low CI projects. Not that they aren't safe, but like I said, there's just more risk to them. And to Evan's point, they're smaller and all that kind of stuff. So it's really, if you're looking to, make the most money, but you're willing to take some risks, then you go dairy. If you're looking to just kind of make it easy and get a 20-year offtake with somebody for, a couple dollars a spread, then you might go to the landfill.
So Brian and Doug, maybe you guys can build on that, and how from a legal perspective, how some of these financing structures work, maybe how the contracts are entered into.
Before we go there, if you don't mind, I'm going to hijack one more time. And I want to go back to Evan and Ryan, and I want to test what they just said in connection with the ability in terms of feedstock optionality as it relates to which one might be better from a offtake perspective if you're looking for a industrial use for carbon dioxide, and if you see it going that way. And does that change your view at all?
Well, I think, all of these processes result in carbon dioxide. There's just a lot more of it. with the landfill because they're larger. But there's a perception issue commercially with landfills. The highest quality of CO2 being beverage quality, but it's pretty hard to convince Coke or Pepsi to put trash gas in their beverage or even beers. But there are other commercial uses. And right now, because of the Section 45Q tax credit, there's a lot of CO2 that's actually being taken off the market because it's being sequestered, which gives you the highest value under that tax credit. But now you have people in the food processing industry and other, for instance, the vaccines that we're all aware of right now are actually refrigerated using dry ice, which is CO2. So there is concern on the commercial utilization side of CO2 right now that the supply is going away and yet the demand may be increasing. It's of interest to me. I am looking at capitalizing on what's now a waste stream from renewable natural gas projects to utilize it on a commercial basis. And we're now getting interest, I think, more because there's concern from the ultimate consumers of that there are other supplies may be going away, which is primarily CO2 off ethanol plants.
And I would certainly, I think, completely agree with Evan and what he's saying. Obviously, when you're looking at these investments, you want to look at all of the opportunities you have to maximize on the profits, as well as just, again, reducing your risk. And it's not even just the CO2 that you've got that you can make money off of here, but there's fertilizers that are being made with some of the byproducts that are happening here, and some other things like that. So there's more than just the renewable natural gas that you're kind of generating from these. From processing these wastes, there are a lot of other revenue streams as well, and in some cases, those can be worth as much or more almost than the renewable natural gas.
Yeah. Can I piggyback there and just ask Ryan and Evan to talk about hydrogen a little bit and where they see that playing into the mix?
Yeah, and again, I would just say if I was going to get a soundbite for this, I would say that it's a waste to waste. And to your point, Doug, in terms of hydrogen, again, out here in California, we have an executive order that says by 2035, we're not going to have the sale of new vehicles that have any tailpipe emissions. Well, as good a fuel as renewable natural gas and CNG is, they still have some emissions. Okay, and this is a move, that's consistent with the electrify everything. However, hydrogen does not have tailpipe emissions, and yet it can be derived from a hydrogen dense fuel like renewable natural gas. So it's a renewable fuel that can be converted using steam methane reformation into hydrogen, which when used as a vehicle fuel does actually produce electricity. So it is a fuel cell electric vehicle with zero pipeline emissions. So the more that we have the movement towards this electrify everything, again, it's very consistent with the utilization of renewable natural gas for a different end product. So I'm excited about that. And I think there's a huge movement towards hydrogen. Japan, for instance, has already said hydrogen's our fuel. Mm-hmm. So they've already committed to do that. I think we're going to see more. There's a lot of the major automotive companies are moving towards fuel cell electric vehicles here. Which is an exciting development, and again, I think underscores the demand aspect for renewable natural gas, which can be delivered, as you pointed out, elsewhere through the existing natural gas pipeline system anywhere, where it's very difficult to put pure hydrogen in pipelines because of the embrittlement issues. We have half as many miles of natural gas pipeline companies, pipelines in this country as we do roads. So it's a really robust existing system.
Now, getting back to I'm sorry.
I was just going to say, building off what Evan just said, the electrification of the transportation sector is happening. And like he said, California has mandated it. And you've seen many companies come out and say by a certain year, they're only going to sell electric vehicles. So that means we're going to just have increased load in the electric sector, to power the cars, meaning we're going to need more power plants, more solar, more wind, more backing up of the renewable energy, because that electricity is going to have to come from somewhere. And the hydrogen piece is something that I know is, being looked at seriously in the electric generation industry, and is another opportunity for whether, power plants can be powered with hydrogen as a way to have a more renewable means of generating reliable electricity that's not intermittent.
Yeah, and one other actually supplement to that, Allison, is, for the heavy duty vehicles, and that includes locomotion, battery electric is a difficult fit. Batteries are very heavy, so you get enough batteries on there, you have to start taking payload off, and it's 5 to 6 hours to charge a truck, where you can fuel a hydrogen fuel vehicle the same you would with gasoline or diesel. So there are some clear advantages operationally to hydrogen as well.
I agreed. I mean, Trillium is I think has a very strong, pro view on hydrogen in the future. It may not, be the next thing next year, but it's definitely going to grow and I think become, honestly, I think, 20, 30 years from now, it could be an enormous industry, not only in transportation, but just in any ability to move electrons. Basically you can put solar and wind where there's plenty of space for it, and you can gasify or liquefy your electrons and move them to where you need them, and then do distributed generation on the other end. If New York doesn't have enough solar, then haul it in. And that's exactly what Korea and Japan and other nations are looking at as well, where they want to reduce their emissions and greenhouse gases. They don't have the ability to put all of the power generation on site in wind and solar in country, and so they'll go to Australia and put all the wind and solar there and bring it in. So I think hydrogen is going to be a huge part of our futures when we've all slowed down 40 years from now to 7 days a week.
Allison, what are you seeing? I know the infrastructure bill is still up in the air, but what are you seeing in terms of policy changes that might be coming down the pike?
No, I have not been following that as closely as I know some of our consulting folks are, but there is a lot in there in terms of really trying to spur development along the lines of all of what we're talking about, and really incentivize development and use of more renewable forms of energy. But there's also pieces in it where it penalizes the use of fossil fuels. So for example, methane taxes on leaks of methane from pipelines and things like that. So I think our consultant folks would be able to give probably an hour-long webinar on what they're seeing in those bills. But definitely a lot of forward-thinking ways to try to incentivize a response to climate.
That's McGuireWoods Consulting as a plug there. But Brian and Doug, just want to kick back to you one more time, see if you have any more comments on structure and.
Well, I think one of the things that we were touching on there throughout the conversation plays into the structure of the deals. It's where you're getting it and who's taking it on the back end. And a lot of these transactions, if you take the most basic transaction, will involve some sort of purchase of the source and then some sale of it, and there could be one or two intermediaries at a minimum involved there, a marketing entity. So you'll have that sort of basic agreement for purchase. Sometimes it's just a regular old NASB contract. Some people like to use their own forms of agreements, and then depending on what credits are being, whether you're using a RIN or the LCFS, there might be different contracts to deal with whether the credit is being attached to brown gas, separated from green gas and attached to brown gas, or it follows all the way through on one stream to the offtake. So you'll have, and those agreements have different names: feedstock, offtake, depending on the construct, and but basically it's just a buy-sell mechanism and a way of attaching and reattaching the credits depending on the ultimate use of them. And at the end, you have in each of the RIN and LCFS scenarios, you have a tracking system at the EPA and at the California Air Resources Board level, where the parties basically enter their information to match the buy-sell component of it, if you will. That's a loose description. I'm sure we could get more detailed, and I certainly will allow anybody to go into it more. But that would be the basic construct for how it would work. Brian, anybody want to chime in?
No, I echo everything that you just highlighted there. The one item I would like to stress upon, and it's something that we touched upon, is just the composition of the feedstock. And it's not something that's going to be consistent in nature at any point in time because it comes from nature. It is something that over time that your contracts and subsequently your financing are need to take into account that there are ambient conditions that are going to impact the quality of the feedstock rather, that's going to impact the ability for you to generate certain levels. Now, your offtake agreements and your gas agreements will take that into account, but you need to make sure your financing agreements take that into account as well. Whether you're dealing with landfill gas, whether you're dealing with swine waste, dairy waste, if you're dealing with wastewater, all of those are they all have an impact in terms of the ambient conditions, the external factors they're going to impact the overall quality of that feedstock, and then likewise the quality output from that feedstock. So that is for our developer friends that are on the call today might have experience in other forms of generation. The consistency of feedstock is something that really needs to be top of mind as you're going through any kind of financing mechanism, and making sure your documents are addressing those issues.
Yeah, I mean, when you get into feedstock risk and things like that, Brian, that's a really good point. And I'm sure Evan, Allison, and Ryan can jump on this, but you brought up, there is a lot of risk when you start mixing things together, particularly when you're trying to qualify for one of these pathways.
Right.
That's a significant risk. You want to make sure that you aren't adulterating your feedstock in a way that's going to disqualify you. So, and two, just from a simplicity perspective, I think the playing field is littered with casualties of mixed feedstock situations that have gone, that sound great. And this is from the lawyer perspective, just having seen it, but that tend to play more like science experiments than they do actual energy fuel production and dispensing projects. Ryan, Evan, do y'all want to comment on the feedstock, issue at all?
No, you're absolutely right, Doug. And from a development perspective, we hate failures because then it raises the concerns of the entire community about projects in general. Feedstock risk is one. There are some other technical risks, although I would say that's not a very great one, given the fact that most technologies are there. But, you're not going to pick up a landfill and move it. It might close, but whatever's in the landfill is going to generate gas probably for the next 20 or 25 years. So it somewhat mitigates that. That's less the case when you're dealing with different feedstocks, such as animal waste, which have, a much shorter duration for the anaerobic digestion process. And, one of the things that has happened historically, not frequently, but occasionally, somebody builds a project at a dairy and civilization moves closer to the dairy. They start objecting to the dairy and the dairy just picks up and moves. Well, there goes your feedstock. So there are risks like that. There's health risks to the animals that can create interruptions, although those kinds of things, normally business interruption insurance, there are ways of doing a financial engineering aspect to deal with that. But, depending on what you're looking at, the feedstock risk is different. In the thermal conversion technologies, normally you're going to get a feedstock supply agreement, probably from a municipal entity. So that risk is going to be less, and there's probably going to be more of a homogeneous feedstock that comes into your plant, so it lessens. So a lot of that depends upon, what feedstock you're talking about, what kind of a project you're talking about. And again, the ones that I think have the highest risk tend to be the smaller projects, which are the animal waste projects.
I mean, you mentioned, obviously, hate failures, but to the extent that there are failures, what opportunities do you see in terms of, stress or restructuring type opportunities?
Well, one of our most successful projects actually came from a failure, and it highlights some of the things that we've talked about today, and that's the McComas Bluff landfill RNG project. And we're the fourth owner of that project. And all three prior owners went bankrupt, and it wasn't a technical failure. They collected landfill gas, they produced it using very commonly used oil and gas technology to upgrade it to pipeline qualities and deliver it into the pipeline. However, they were delivering it and selling it the same way as if it were a natural gas product, which was basically at a discount from a wholesale natural gas index price. And so when natural gas prices were high, project did well. When they were low, they went bankrupt. And because I have this checkered past, having dealt with a lot of different technologies, and I tend to be both technology agnostic as well as end use energy product agnostic, I'm in the same business that everybody in this telephone call or this webinar is, which is the making money business. And so I tend to look at things with what I call all you have to be a successful developer in the renewable natural gas business is meet the requirements of the secret formula. Now, given the fact that we're all under the cone of secrecy and confidentiality here, you can scoot a little closer to your monitor because I'm going to reveal the secret formula, and that is revenues must exceed expenses predictably. Now, that's simply stated, but I will tell you that it takes an enormous amount of effort to meet the requirements of that, particularly the last word of that, predictably. Because what was happening with the prior owners was they were having revenues exceed expenses occasionally, and that didn't work. And so what we did was, because I had done a lot of electric power projects, and I think Brian referred to the RECs, I went to natural gas power plants owned by utilities and said, look, if you take this gas from a natural gas pipeline, like you're taking regular fossil gas, and you put it in your very efficient combined cycle turbine, you're going to produce a lot more renewable electric power. Therefore, you can afford to pay me a higher price for my renewable natural gas to achieve that. You have no operational changes at all. So we ultimately ended up selling a long-term agreement to Shell, where we got a 14-year take and pay agreement with double-digit pricing at a time where natural gas was selling below $2 a million. And then, because basically renewable natural gas development is a team sport, and I was fortunate to have on my team McGuireWoods, Doug, and some of the partners in your firm worked with us on that. We were told, because we wanted to go sell a tax-exempt bond issue, and we were getting trying to get an investment grade rating of that from Fitch. And they said, yeah, but you have 5 megawatts of baseload power here. We want you to fix that power and not have this be volatile so that you might have expenses exceed revenues at one time. So we ended up getting a long-term agreement that went all the way up to the board of directors of Exelon, which owned Constellation Energy, and got the longest term power purchase agreement in their portfolio. So we then had revenues exceeding expenses predictably. We got an investment grade rating, sold that 40.2 tax exempt bond issue, and that is now one of the more successful financial projects in the country, but it came out of a distressed asset. And those opportunities do exist today, but I think that the greatest reason out of the three forms of engineering, which are technical engineering, financial engineering, and political engineering that are involved in every project, financial engineering is the greatest reason that these projects fail.
Thanks, Evan. That was very helpful. I think with the last couple of minutes we have left, I'll go to some of the questions we had. One is that given that so much of the revenue streams of RNG projects are dependent on the value of the LCFS credits, what sort of risks do you see in the long-term value and structure of LCFS? How likely is it that
well, I would disagree a little bit with that, because I think actually when you look at RINs, a D3 RIN, let's assume it's a D3, not a D5 RIN, and it's at $3, just the value of that is $33 plus the brown gas. So we are doing renewable natural gas projects on landfills without any LCFS credits. So LCFS credits certainly are a yield enhancer. You get a lot more if you qualify for them, and you can find somebody like Ryan's company that has capacity to put them in. That's one thing I'm concerned about. One of the things, the areas where there's opportunity, like what we did, because I should mention the McComas Bluff project we did was done in, the financing was completed in 2011. There was no cellulosic RINs available at that period of time. That didn't come in until 2014. So using that model and going back to what Allison talked about, you now have the opportunity to look at some of these offtake agreements that are not dependent upon the renewable fuel standard, the federal program, or any state LCFS program to support it. So you could use a blend of approaches if you wanted to go to the transportation market and anchor your financing and meet your covenant that you wish to do for financing using ESG type financing. And there are some attractive agreements longer term that are becoming available in that market now. And then you can play the market, on a merchant basis for the balance of your revenue. So there's a lot of really interesting financing approaches that are available to do these projects that are coming to light now.
And I agree. Everything Evan said is absolutely correct. Although, and as he said many times, when you get to the smaller, low CI projects, at the end of the day, LCFS pricing is probably going to drive the finances on those projects in today's market. I think that there are opportunities to try to, I guess, kind of play some games. We've seen some people where like maybe they sell the gas at a fixed price at a normally much higher price than you would get from like a landfill gas, and then take that gas and cycle it into the transportation market while the getting is good, and kind of use that to kind of help offset that higher price for what is eventually a longer term usage. Also, with the ESG goals that some people will have, you can also do something there where, like, just to say you've got a trucking fleet like UPS or something like that that's operating across the country, send as much of that low CI gas to their UPS fleet in California, bring the CI score way below zero, and maybe they don't have to do as much in Georgia or anywhere else, and they can still end up with that carbon neutrality that they might be looking for. And so those are ways that you can kind of try to finance and take advantage of the current LCFS market. I believe it was Doug that mentioned earlier, Oregon does have an LCFS program as well. There just isn't as much demand in the state. Washington at least voted it in, so that'll be coming into play here in the next year or so. British Columbia has one. So there are other places, to go than just California, but California is where the gold rush money is at today.
One last question here before we sign off. It's a question about microbial digesters in coal. If you guys have any thoughts on that.
They're all microbial digesters. Basically, you have the microbes that work in anaerobic conditions that produce the gas. I'm excited though because there are some technologies that can result in lower hydraulic retention times. So it happens faster. You can produce more gas in less time, which means your capital is lower. There are some pre-treatment systems for the raw material that goes into digesters that it not only accelerates the rate of digestion, but increases the amount of the material that converts to gas. So there's a lot of things happening with anaerobic digesters because, again, a lot of these technologies we're talking about have been around for a long time, including the thermal conversion technologies, which have been around, more than 100 years. But they're being refined, and the applications of them and the financial engineering of how projects are put together are being refined, which is why I'm excited about the future.
There's those projects aren't without technology risk, even AD. I mean, there are plenty of risk factors there.
Absolutely.
Any last words from our panel? Well, I want to say thank you to everybody. Really appreciate Evan Williams and Ryan Erickson joining us from Cambrian Energy and Trillium, respectively, and then our McGuireWoods colleagues, Doug Lamb, Brian Kelly, and Allison Wood. Appreciate everybody joining. It's been a great panel, and we'll be in touch with future panels to come. Thank you, everybody.
Thanks Tom.
Thanks all.
Ryan, Evan, thank you.